Hello and welcome. Welcome to the second session of our webinar series, Fostering Green Recovery Through Climate Technologies. My name is Nancy Finger, and together with my colleague Julia, I'm hosting today's session, Financing the Deployment of Climate Technologies. Unfortunately, two of our speakers, Michael Büchel from the Federal Ministry for Economic Affairs and Energy and Frank Wolke from the German Emissions Trading Authority, DEST, cannot participate due to illness. Which is why we had slightly to modify the agenda and now welcome Joachim Schnurr from GFA instead. Thanks for joining, Joachim. Maybe just a few comments on the webinar series itself for those of you who join us for the first time. The webinar series consists of 4 sessions in total, which all will be published on our website afterwards. We've invited international experts to share their perspective on technology transfer and to address the question on how the private sector and market mechanism can accelerate technology transfer. This webinar series is organized by NDE Germany. NDE Germany is one of the 158 focal points that have been created under the framework of the technology mechanism of UNFCCC. Our aim is to facilitate the introduction, use, and transfer of climate-related technologies worldwide. NDE Germany is hosted by the Federal Ministry for Economic Affairs and Energy, on whose behalf the webinars are being organized. Let me give you a brief introduction and have a look at the objectives of the technology framework under the Paris Agreement. One of the objectives is the collaboration between Annex 1 and non-Annex 1 countries. A basis for this was created by the following institutions under the UNFCCC. One, and you can see it on the left-hand side, is TEC, the Technology Executive Committee. TEC is responsible for the legal framework, and on the other side you can see the Climate Technology Center and Network, CTCN. CTCN allows different actors coming together and starting cooperation. CTCN includes technologies providers as well as NDEs from Annex 1 and non-Annex 1 countries. Another objective, of course, is the implementation of the Paris Agreement, which won't be possible without technologies. So what we've seen in the past, that renewable energies, they have proven that they have the potential. But if we look at the graphic, we actually can clearly see that we need a transformative change in all the sectors and not only in renewable energies. So in other words, we need technologies and we need a transition. We need a transition from fossil fuel driven mobility to e-mobility. We need a transition to low carbon buildings, to a full circular economy for waste, and to a sustainable agriculture. So really the ultimate goal is an accelerated transfer of climate technologies. And in order to achieve this, and to reach the target of the Paris Agreement to keep the global warming below, ideally 1.5 degrees Celsius, financing becomes a very important part of it. So we need to finance the right technologies, but of course the question is, what are the right technologies and which technologies will finally lead us to the 1.5 degree Celsius target? To answer this question, we might need to think about technology standards, technology benchmarks. Technology benchmarks or standards were actually discussed in one of our first sessions last week, in which we're focusing on the high-emitting industries such as steel and cement. In our panel, we had speakers from Agora Energiewende, First Climate Consulting in Switzerland, Heidelberg Cement, and ThyssenKrupp. There was quite a consensus that one, the ambition level needs to be similar across the countries worldwide, that Article 6.4 of the Paris Agreement has the potential to drive new technologies, and that the exchange of carbon credits requires robust accounting in the host countries, in the issuing countries, and also robust national NDCs based on solid global technology standards. Apart from technology standards, financing is crucial as well for the transformational change. So not only traditional private financing plays a key role, but also market mechanisms such as emission trading, as we just said, and public sector financing are important for the acceleration of technology transfer. The question, of course, is how can we accelerate the technology transfer? We can probably accelerate it by defining technology benchmarks, ideally independent from the financing option, and also by financing the right technologies, considering that emissions should be reduced where they're most cost efficient. I would leave it here. I would stop here and leave the more detailed discussion up to the experts later on. But maybe just a few formalities, just a few remarks from my side regarding the webinar and how to interact with each other. So what we are going to do, our speakers will first provide short inputs on today's topic. And then afterwards, we will have a panel discussion for which we'd like you to participate by raising questions. All questions are more than welcome, so don't be shy, just raise your questions. However, you're muted, all the listeners are muted, but what you can do is typing in your questions in the Q&A box, which you will see on the bottom of your screen. You can ask questions either about one presentation in particular or to the panel in total for the panel discussion at the end. It would be very, very helpful if you could indicate whether your question is addressed to to a certain speaker or to all of the panelists. My colleague Julia will make sure that all your questions will be integrated in the webinar. And maybe at this point, Julia, you can show yourself and quickly say hi to the audience.
Hello, everybody.
Great. So I would say we are all set. Let's get started. And I welcome Joachim Schnurr from GFA. Joachim Schnurr is the head of the Climate Competency Center of the GFA Consulting Group, and he's responsible for coordinating the company's activities in the areas of climate change, climate and carbon finance, planning and implementation of emission reduction projects, renewable energies, and energy efficiency. For more than 15 years, Joachim has been working for both private and public clients in the context of global carbon markets, and is therefore very familiar with the development of new market mechanisms and climate protection financing by institutional donors. I would say, and the floor is yours, Joachim.
Nancy, thank you very much. Dear participants, Nancy gave me only 8 minutes to dive into a real complicated subject. And this is why I would suggest to start immediately. And the first issue I was asked for to present to you is about a short summary on the status of the Article 6 negotiations. And I think most of you are familiar with the so-called market-based mechanisms under Article 6 of the PA. So we have Article 6.2, the so-called cooperative approaches, which are mainly related to bilateral agreements between countries for supporting countries in reaching the NDC targets and for supporting them in increasing their ambitions until 2030. So in return for financial support provided, the recipient countries are obliged to transfer so-called ITMOs to the financing party. It's very similar to international emissions trading, or also to the so-called JI Track 1 under the Kyoto Protocol. It's mainly an instrument which is used between governments, so it's a government-to-government agreement. And we think that Article 6.2 may be the first mechanism that actually is going to start, because it's less complicated, it has less complicated procedures compared to Article 6.4, which is the so-called Sustainable Development Mechanism of the Paris Agreement. This is supposed to be centrally overseen by international organization. Most probably this is going to be UNFCCC. And again, there you see that for financial support that is coming to the countries would be obliged to transfer ITMOs to the donating country or to the donating party. It's very similar to the CDM or JI Track 1 under the Kyoto Protocol. And it's a little bit more complicated than Article 6.2 in terms that private sector actors wishing to invest under Article 6.4 will certainly be required to obtain authorization from the party, from the country where the mitigation action is located. So if you look at the NDCs that have been submitted under the Paris Agreement, it looks, you see that about half of them are interested in using any forms of international cooperation through Article 6. And it's a framework actually that will enable the creation of an international carbon market. At least that's the ultimate goal. So the problem that we have at the moment is that there was no consensus reached on the so-called Paris rule book at COP25 in Madrid, which was a big backdraw. So, and now we are faced with the situation that COP26 is postponed because of the COVID-19 event. It will take place only in 2021. So we can only expect that final negotiations on the Paris rule book take place only next year, which will cause a severe delay in implementation of this market-based mechanisms. So what are the main topics that remain unresolved, and what was the reason for not coming to a consensus in COP25? I just listed them here briefly. It's about the so-called corresponding adjustments to avoid double counting. That means if IPOs that have been transferred to a donating country would have to be, that means that the national NDC targets need to be adjusted accordingly. Then it's about the taxation of transactions under Article 6.2, the proceeds that are need to be given for adaptation purposes. A big issue is the transition of CDM activities and units from the Kyoto Protocol to the Paris Agreement. Some of the countries insist on that, and other countries, like for example the EU, are completely against that. And then of course it's an ongoing discussion about baselines and additionality of programs or projects implemented under the Paris Agreement. Despite the fact that there is no Paris rulebook in place for the time being, you see already so-called, I call them first mover programs, like the ones, for example, from Switzerland. It's the Click Foundation that has provided 500 million Swiss francs for respective climate-related activities in other countries. And the Swiss government intends to use this ITMOs that are transferred for compliance under the Paris Agreement for setting off emissions in the Swiss transport sectors. Then we also saw another tender that was published by Sweden through the energy agent, the Swedish Energy Agency, and the first proposals have already been submitted to that. You see also, so you see that there is already movement there, despite the fact that no final stipulations for the Paris rulebooks could be agreed upon. Could you move to the next slide, please? Julia and Nancy. So I would like to demonstrate to you, based on a practical example, how this financing really could look like in practice. So we have, at the moment, we are establishing a program for the German government. It deals with the reduction of technical losses in transmission and distribution systems in the Southern African region, actually in 4 countries, Uganda, Zambia, Mozambique, and Zimbabwe. And it's a kind of a first pilot program of the German government to be implemented and to test innovative funding instruments, combining in a so-called blended finance approach, climate and carbon finance for crowding in private sector investments in such mitigation activities in the country. So I think reactive power compensation, RPC equipment, which is ultimately the goal of this program to be established at industrial facilities, is actually a proven applied standard in all industrialized countries, but you don't simply have it in sub-Saharan African countries, where you have technical losses in the transmission distribution grids amounting to around more than 20%. So the program tries to tackle this particular problem. Next slide, please. So, and this program has a lot of benefits, multiple benefits. As I said, the investment needs to be done at the facilities of industrial customers who are going to invest in the installation of this so-called RPC equipment, which would lead to a reduction of their energy payments and then, of course, increase their competitiveness. At the same time, it has an effect on the whole grid because it reduces the technical losses in the national grid, which is, of course, a big advantage for the utilities and distribution companies because they need to provide less power to the grid, and they could and do that at lowest costs. At the same time, of course, it leads to the reduction of greenhouse gas emissions, and this contributes to the achievements of the NEC targets. And of course, it has a socio-economic effect as well, because it's improving the energy supply in the countries, which is sometimes really poor, and it leads to the reduced or stable power tariffs. So the question is simply, if you have all these multiple benefits, why hasn't this technology been implemented by now in those countries? Although it's a proven standard technology. The main reason are the high upfront capital costs that you have. We are, in most of the countries, you are faced with interest rates above 20%. And to some extent, there's of course also a lack of awareness that such a technology exists. Could you move to the next one, please? So it looks like a very complicated structure, but I would like to have you focus on the upper section, okay? Because this is the blended finance instrument that we have developed for making this program really to happen in those 4 countries. So it's on the right-hand side, you see export credit agency cover. So in each of the industrial countries, you have export credit agencies. In Germany, it's operated under the Ministry for Economic for Economy. And the German Export Credit Agency gives a complete risk, political risk insurance and a commercial risk insurance to a South African bank. In our particular case, this is a Standard Bank, which is located in South Africa, but has subsidiaries all over the place. So we needed a bank with an African footprint. And these guys are actually managing what we call the ESCO fund. So they get the export credit agency cover, which allows them, because the risk is taken by the ECA, to reduce the interest rate to a level of 8 to 9%. So at the same time, and then it's the left-hand side of this graph, you see BMU carbon finance, which stands for a carbon finance component, which is provided by the German Ministry for the Environment. And this is actually a subsidy or a grant in return, which is provided in return for ITMOs. And it needs to go through a development finance institution because BMU cannot directly finance a private bank. But on the other hand, the export credit agency only covers about 80% of the total value of the equipment. So there's a concessional finance also coming from the DFI involved. It's not only to channel the funds from BMU, but also that they are providing guarantees or taking part of the concessional funding. In our particular case, this is the African Development Bank. So, and then we have what we call a blended finance instrument that allows the energy service companies to get very cheap loans, which at the end of the day allow the private customers who are implementing this technology to pay back the investment within less than 6 years. So, and then it becomes a business case for them. The next slide, please. So, but this is not all. What you have seen here is the right-hand side. This is the development of this so-called a finance product, a finance instrument that addresses the gap between the economic viability and the financial viability that you need to have a business case for the private sector. At the same time, we had a number of discussions, workshops, meetings, agreements with the ministries for energy in the different countries, with the regulators, to improve the national policy and regulatory framework conditions. That means that they increase the tariff payments so that there is a certain pressure on the industry to really implement this type of equipment. So it's what we call a push and pull approach. On one hand, you raise or you increase the regulations. On the other hand, you offer the private sector a financial instrument that allows them to really go for this type of investment. And that is reflected then also in the NDC, because the carbon finance that is provided is part of the so-called conditional NDC target. And the improvement of the regulatory framework accounts for then the unconditional NDC target. And I just also would like to mention that the introduction of technology benchmarks here, for example, that you have a clear regulation with regard to the power factor that is regulated by law, it gives them the opportunity really to go for an investment for a standard but also state-of-the-art technology in those countries. And I think that was it already. Thank you very much. Nancy, I hope I met your time frame.
Thank you very much, Joachim. Very, very interesting. You almost made it in time. Thanks a lot. A question to you, Julia. Is there any question from the audience yet, specifically to Joachim?
Yes, we've received 2 questions. One is a bit more political and broad, so I would maybe pick this up a bit later. But there was a question from Ben regarding the institutions in Zambia that were involved in the project and who facilitated the submission of the project. Maybe if you can briefly talk about Zambia in a few words.
It's not only Zambia. In each of the 4 countries, we had 4 local main stakeholders that were involved in the discussions around the development of this program. It's in the first place the Minister of Energy and the regulator, because they are the regulators in charge of the tariffs. And at the same time, it's of course the utilities and transmission companies in Zambia. And then also we had representatives from the private sector, especially from the big mining sector. And finally, but absolutely required, is the national focal point for climate. Because at the end of the day, when such a program is implemented, a transfer agreement for the ICMOs needs to be signed between the 2 governments. It's part of this bilateral agreement. And the respective institution in the country is normally the national focal point, which is normally located in the Ministry for the Environment. So they would then enter into agreement with the German Ministry for the Environment on the transfer of ICMOs, on corresponding adjustment and the other issues that are related to this program.
Okay, thank you very much, Joachim. Let's move on to the next speaker, and as Julia said, we would address the other question later on. I would like to welcome Katarin Wagner from HSBC. Katarin Wagner is the head of corporate sustainability. She has worked in the Evangelical Church on the integration of sustainability criteria and capital investments, and has gained a lot of expertise across several areas within HSBC. At the moment, Katarin is complementing her degree in business through an MBA in sustainability management in Lüneburg. Katarin, the floor is yours.
Yes, good afternoon, everybody. A warm welcome from my side, and thanks for having me today. So hopefully you can hear me. So what I wanted to do today is to give you some insights on the sustainable finance market and the impact of the current regulations that we see. So next slide, please. So what will I do today? I wanted to give you an overview of the drivers of sustainable finance in regard of regulators. Then I will go over to climate risk management, to the European Union and the EU action plan, and finally give you some insights on the current product development that we have achieved right now. So next slide, please. So first of all, probably the starting point in regard of sustainable finance, or a bigger push. So in the end, sustainable finance is not a very young story, but the biggest push that came, and what we see during the last years, starting from Paris Agreement, is the aspect of regulation. So the push comes really from the regulators, and we do see that since the Bank of England and the G20 states decided to cover climate risks for financial institutions, there's much more broader development within the financial sector. So next slide, please. So where does the push come from? First of all, there's a big investor demand in regard of sustainable finance. So big investors like BlackRock, for example, or the Norwegian pension fund, they do have a big interest in sustainable investments and do want to be sure that the money that they invest is in a way sustainable. Secondly, the push comes from the regulatory side, which I mentioned earlier before. And what does it mean concretely? So in 2017, the Financial Stability Board set up the TCFD and gave a recommendation in regard of how companies, and so from an investor perspective, how companies can better align their climate risk within their business models. So this recommendation is very much straightforward, and this is a current disclosure recommendation aspect that a couple of institutions have disclosed so far. So for UK, which is from my view essential for a British bank that HSBC is, we do see that the Bank of England, the British regulator, set up a climate stress test announcement, and a couple of other initiatives have been set in place. So as I only have 8 minutes, I will make it as short as I can. So, and finally, from the governmental side, we do see a big push as well. So in the end, climate change is a problem that governments want to face and want to cover, that we see within all the SDG development and NDCs, etc. So there are a couple of initiatives set in place by the government. So for Germany, for example, do have a carbon objective and carbon target for 2015. It's the case in the UK and in France and even China. So next slide, please. Now I will refer to climate risk management and why is it that important for a financial institution. Next slide, please. So what is in fact the concern given by the regulatory side? So financial risks that arise from climate change have not been covered broadly from a financial institutional side, to be honest. So we have been aware of climate change, but did not consider it properly within our balance sheet. In the end, what we have understood right now, or we are still in the beginning, to be honest, but what we have set up at the moment is to better underline our strategy and governance within climate change. And what does it mean? So when we talk about climate risks, and according to the TCFD recommendations, they do consider, in regard of climate risk, 3 risk types. First of all, it's all about physical risks. Then there is aspect of transition risk, and third, there is a liability risk that we do need to cover. So in the end, when we consider and when we set up our sustainability strategy for the wholesale bank, in the end, we decided to first of all cover transition risk, because our exposure is significant in regard of scope 1, 2, and 3 emissions in our carbon footprint. So physical risk do arise. And we are both affected by physical risks for sure. So for example, we need to consider where corporate clients do have their plants, so from a local perspective, of course, but in the end, we are most affected by transition risks, and we need to better consider these within our risk assessment when giving a loan and from the portfolio management as well. So second slide, next slide, please. So this slide gives you an overview of the regulatory agenda that we do see at the moment, and it's so what you can see is that in the past 5 years, the sustainable finance regulatory development arised. So this is which is really good from my view. So I have been always waiting for a push like this. So, and there are currently a lot of global initiatives that we as a bank that is operating globally do need to cover, which is not that easy, as you might know. And on the other hand, we do see that there are that a political framework that is in place is very much helpful to have a reliable framework in which we operate in the end. So what we see in the UK is that they, due to Marconi and the Bank of England initiatives, there are a couple of legislatory processes in place. France was very much advanced. So in 2016, I remember they set up this Article 173, French energy transition law, and what you can see is, since you have a policy in place, the market is easier to develop. Next slide, please. In regard of TCFD, which means Task Force on Climate-Related Financial Disclosure, so in the end, TCFD is much more easier, to be honest. So the TCFD, which was underlined by the Bank of England, they do have 4 or more or less 5 steps that you need to figure out. So governance and strategy, these are the most important steps. So you do need to have the agreement and the support of the board. The board needs to understand and to assess financial risks, and you do need to have an idea how your balance sheet is affected by climate change. So if you set up a TCFD, and if you take up the journey to do the TCFD disclosure in the end, you do need to cover governance and strategy at first. And all the other aspects, such as risk management, scenario analysis, and disclosure, will come later on, and is a process. So in the end, what I know from my experience so far is that some of the German companies are kind of reluctant to disclose TCFD because probably from a German habit, you do think that you need to cover all before you disclose something, and from a British perspective, you take up the journey and see what will comes next. So in the end, this might be an easy explanation, but in the end, that's really the point. So next slide, please. So what is the TCFD about? When you talk about transition risk and physical risk, you do need to cover and to ask yourself how resilient is your business and your business model? What kind of risk do you need to cover, and what kind of opportunities do you see in regard of climate change? It's not always, it's not only about risks. where there is risk, there is always an opportunity behind, but you do need to figure this out and ask yourself, what is the financial impact in the end? And this does have a direct influence on your income and on your balance sheet. It covers, you do need to cover your assets, your liabilities, your capital structure, your revenues. So in the end, if you take up if you decide to disclose TCFD, there's a very much there's a huge kind of change management process that you do to cover. Next slide, please. This is an extract of our annual report that came out in February this year. I mentioned earlier before scope 1, 2, and 3 emissions. So if we talk about a bank's carbon footprint, what we did in the past few years was that we thought our scope 3 emissions is only about travel, for example. Our understanding in regard of scope 3 emissions for a bank is now some more advanced, but still in the beginning. So this means that we try to figure out how much emissions do come from our loan book and from our wholesale portfolio. And this was a very much bottom-up approach, to be honest. So we did a lot of interviews with our clients. We did a lot of Excel sheet analysis and tried to figure out in which sectors we do see transition risks. And we developed a questionnaire together with our clients to better cover climate risk within our loan analysis. So in the end, we have set up a transition risk questionnaire that kind of goes along with the sustainability risk policies that we have set in place a couple of years ago after the Equator Principles were published by the World Bank. So, but in the end, the aspect of transition risk is very, very new. And what we know is that our wholesale portfolio is affected by transition risk, and this means that more than 20% of our wholesale portfolio worldwide is affected by transition risk. So in the end, we are the biggest bank in Europe, and we are number 7 in the world. So this gives you an idea how much risk there is within our loan portfolio. Next slide, please. So from the European agenda, we do see a big push in regard of the activities to be climate neutral in the end. That comes from the European Green Deal, which is very new. That came up last year. But the EU Action Plan already started before, and the EU Action Plan set in place a couple of mandatory legislation that does have an impact on our business model. So we do need to consider a lot of new laws within our daily business, and for example, the taxonomy, which is probably the most essential part of the EU Action Plan, and took a lot of months to get this settled. So the EU taxonomy is currently the one and only tool, kind of guideline that we need to consider for our product development. And this means that the EU taxonomy has 6 objectives in the end, but 2 objectives need to be developed by this year. So this is all about climate change mitigation and climate change adaptation. And a list of economic activities, performance criteria for the contribution to the 6 environmental objectives were given by the taxonomy. So the proposal in the end says substantially contribute to at least one of the 6 environmental objectives that we do see. and these are defined in the proposed regulation. And in regard of the eligibility criteria, you do need to consider the do no significant harm aspect to any of the other 5 environmental objectives as defined in the proposed regulation. And you do need to comply with minimum safeguards and technology transfer. So this is only one slide, but in the end, the EU taxonomy is a 100 slide monster in the end, and it's really difficult to understand. But in the end, it gives clearance for the market. So next slide, please. So what I wanted to show you right now is what does it mean for our finance loan book in the end, and what are we talking about in the end? So probably some of the audience is aware of green bonds, and green bonds are a capital market instrument to finance, as a finance instrument for corporates that that are looking for finance from the capital market. But in the end, it is an instrument that works very well because you have clear guidance, you have principles set up by the ICMA, and the market developed very nice within the past years. But in the end, not every corporate wants to finance, to get finance from a market. So in the end, for the German market, what I want some insight on, German market is loan financed, which means that the lending aspects do come directly from a bank or from a syndicated loan, for example. So what I wanted to tell you, so we do have the green loan principles, and even we do have the support and guidelines from the ICMA, and the products that do run very well are, for example, green loans that finance a concrete investment that contributes to carbon reduction, for example. This is, for example, a green pure loan or a guarantee credit, such as wind turbines, for example, is very interesting project together with one of our clients. So in regard of sustainable supply chains, for example, this is an interesting finance opportunity because if you take a closer look at sustainable supply chains, more than 80% of global trade is about supply chains. And if you cover sustainability aspects within the financing and the treasury departments, you have a big push to underline sustainable development. So in the end, we did a deal with Puma, for example, and we do have a supply chain financing platform to which all the suppliers of Puma have access to. In I remember it's about 70 countries, for example, and our margins, our interest rates do consider the ESG performance of the suppliers. So this is very new, a very new product, but in the end, it's a very good opportunity to give your suppliers the opportunity to be better within your sustainability performance. Another product is, for example, ESG-linked loans. So ESG rating that is set up by a second-party opinion, for example, like ISS Ökom or MSCI and Sustainalytics. So we do consider the ESG rating of the client, and the client sets up an objective in regard of sustainability, for example, carbon emission reduction, less incidents, in less or another SDG objective, for example, and then you link this goal to the financial instrument. So this gives the Treasury Department, the department of our clients, more flexibility, because in the end, you do need to report on the loans that you give and that you have assessed before. But in the end, you are very much flexible within the use of proceeds. Next slide, please. Oh, okay. This is already the end. Probably what I wanted to put some more emphasis on is that we are still at the beginning in regard of sustainable financing instruments. So what we know from our clients is that they, the clients do see an advantage when we are talking about financing, but most of the time it's still a marketing instrument, and I'm really much looking forward for some of your questions. Yeah, thanks for having me.
Many thanks, Katarin. Julia, is there any questions from the audience?
Yes, we've received one from Jacob, who would like to know if there are any industries where transition risk is too high for HSBC to finance.
So we do have 6 high-risk sectors that we've identified, but we do not think that a divestment strategy is a right thing to do. So we do have, of course, it always depends on the business case, and we, within our processes, we do cover all sustainability risks and operational risks, climate risk, transition risk, etc. But in the end, we do not exclude sectors, with one exception, which is coal.
Mm-hmm. Julia, was there any other question?
Not for the moment, no.
Okay. Thank you very much. Then I would say we move on. I'd like to welcome our last panelist for today's session, Stefanos Minas from the Technology Executive Committee TEC. As Olga explained, TEC is the political organ of the technology mechanism under the UNFCCC and responsible for the legal framework. Stefanos Minas is Vice Chair of the Technology Executive Committee, and he's a member of the EU team in UN climate negotiations and a legal academic specializing in climate change and energy law. Stephen holds a doctorate in transnational law from King's College in London. Stephen, the floor is yours.
Well, thank you very much. And can I begin by congratulating ND Germany on this very timely series. It is absolutely right that in the midst of this global tragedy, we're thinking about the recovery and of course about a green recovery. Now, I have been asked to talk about the Technology Executive Committee, the TEC's work on the financing of climate technology. So I'd like to begin by just saying a few words about what the TEC is. The TEC was established by the Conference of Parties to the UN Climate Convention in 2010 as part of its technology mechanism, the other part, of course, being the Climate Technology Centre Network, the CTCN. The TEC is the policy arm of the technology mechanism, and it, as the CTCN, has a mandate to enhance technology development and transfer. The way that the TEC does that is by providing recommendations to the Conference of Parties of the Climate Convention, and now, of course, also the Paris Agreement, by creating publications on various aspects of climate technology policy, most of which are publicly available, and by hosting and participating in various events on these topics. I should also say, in a discussion of climate finance, that the TEC works very closely with the non-state observers and indeed party observers. And in each of the TEC's task forces, representatives of the business and industry observer constituency, as well as other observers, are invited to participate in the TEC's work and in fact do so. So the TEC today is working under both the Climate Convention and the Paris Agreement, including on this topic of technology finance. Next slide, please. Now, as I've mentioned, there are a variety of publications that the TEC has published over the years. And whilst I won't go into them now, they do address various facets of financing climate technology, whether that be encouraging entrepreneurship, encouraging research and development, and so forth. The key message that I would extract from this work over the years is that financing and ramping up financing is really a collaborative effort. It has to involve the public sector, and we've seen the plethora of regulatory activities that are currently underway. And as the TEC has said before, what is really required from government are regulations that are long-lasting, loud, and legal, giving business the certainty to plan and to invest. And of course, there are other important aspects as well, such as matchmaking, bringing technology to markets, capacity building, the use of public finance to crowd in the private sector. Each of these things that my colleagues have discussed already. And of course, all of this applies to both climate mitigation and climate adaptation. Next slide, please. Can I have the next? Thank you. So under the Paris Agreement, the technology mechanism is now working under the overarching guidance of the technology framework, which was established, or rather adopted in 2018. And the key themes of the technology framework, as we see here, innovation, implementation, etc., are now used by the TEC to organize its work, to respond directly to what the parties to the Paris Agreement have asked us to work upon. And each of these key themes relates to financing in some way. I would also draw attention to the principles of the technology framework, including the need for a transformational approach. So this is not just about financing more of the same, but it is about achieving the climate transition that we need in the time that we need it. Now, just to take one of the key themes, enabling environments and capacity building, a lot of this work is very relevant to creating the frameworks for investment in climate technology, and that includes, of course, policies, regulations, and standards from government. Next slide, please. So rather than summarizing the TEC's work on climate finance, I thought I would just draw your attention to one piece of work that we are currently working on, and that is a paper on approaches to accelerate and scale up climate technology implementation. And that includes financing. And you will see here that we have drawn attention to the importance of a number of policy mechanisms that my colleagues have already discussed, such as green bonds, such as classification schemes, such as the taxonomy, and of course benchmarking for institutional investors. Now, this is not a top-down process. The TEC is not proposing to the COP universal standards on these matters. It is merely providing advice which is aimed to be useful for parties, each of which, of course, find themselves in very different circumstances. Next and final slide, please. So just to wrap up, I would emphasize again the role of public sector regulation in making these markets, the necessity for long-lasting, loud, and legal policy incentives, and indeed from the side of parties, the importance and the opportunity of nationally determined contributions as a signal to the market and a signal to the broader climate finance community. And of course, 2020 is a very important year for NDCs. Now, Of course, the publications that I've referred to are all available online, and I look forward to your questions and to the discussion. Thank you.
Thank you very much, Stephen. Julia, again, same question. Is there any question from the audience directly for Stephen?
No, not now.
Okay. Then thank you very much to all the panelists for your inputs. I would like now to continue with our panel discussion. If I may ask all the speakers to turn on their videos so we can start with our panel discussion. Thank you very much. All right. Maybe I would like to start with the first question, actually addressing to you, Stephen. What do you think is the significance of the development and implementation of technology standards for reaching the 1.5 or 2 degrees Celsius target under the UNFCCC?
I think that we need standards for investment. We need, first of all, to achieve the aims of the Paris Agreement, which include making finance flows consistent with pathways to low emissions development and climate resilience. And that means that market actors, investors need to know what to invest in. And that's why in our recent work, we have been looking at attempts to create benchmarks for the market, attempts such as classification systems, such as the taxonomy that the European Union has been working on, so that we do have pathways and signals to investors and to bring the project proponents, the technology originators, and both public and private sector investment. But as I say, the multilateral process is not going to deliver detailed universal standards. It is going to set directions, and hopefully the parties and of course the market and other actors can work towards those standards.
Thank you very much. A comment on this from one of the other speakers? If not, maybe another question from my side. Could you think of any other organizations that would potentially take on the lead in the development of such standards, of such technology standards and benchmarks?
This question is to?
This, whoever wants to take on the question, so feel free to just jump in.
I mean, of course, I think that there is, I mean, for the time being, the future role of UNFCCC is not clearly defined yet. It will be part of the final stipulations of the Paris rulebook. But I would say that if UNFCCC plays an essential role again in overlooking the implementation of these activities under Article 6.2, or especially under Article 6.4, so 6.2 is based on bilateral agreements between the countries, then I would say that UNFCCC could be one of the organizations that could demand the deployment of certain technology standards, especially with regard to really raising ambition and then at the end of the day creating, coming to activities and programs that really contribute to reach the overall global stocktake and the benchmark of at least coming close to the 1.5 Celsius degree target. But I think this is something which requires a clear mandate to be given to such an organization like UNFCCC.
Mm-hmm. Any other thoughts on this?
Yeah, probably I would like to add something. So from my view, there are already a lot of initiatives in place, which might be better linked together. So in the end, I do agree that UNFCCC should be in charge of the strategy itself, of course, but in the end, we do see a lot of industry initiatives. We do see a lot of initiatives that come from associations. Then we do have the OECD guidelines, for example. So there, for such as HSBC, we are taking part in a lot of working groups. But to be honest, in the end, we do need to better link together, so that in the end we do not lose the overview in the end of all the initiatives, and this is very difficult to do from my view, even as a global bank, and even under the political and geopolitical risk, etc., that we need to consider. So when I've listened to the first presentation from Joachim, I was very interested to see the initiatives that really influences the African market. But for global banks such as HSBC, the geopolitical risks that come that we do see in Africa are too high to do a push into the African market. So in the end, it needs to be a balance between political frameworks and industry initiatives, and we do need to be some more ambitious to link these initiatives.
Yeah, thank you for this, Katarin. Maybe a specific question to you. We spoke about the green bonds earlier. Could you think of any incentives that could be created to shift from the business as usual investments into more green investments? So yeah, just to increase the share of green investments.
Yeah, in the end, it's all about the interest rate. That might be an incentive for the client, but in the end, what we do need to put emphasis on is that you kind of broaden your investor base. So if you do a green bond, or if you do a yeah, from a bond perspective and from the capital market, you do arise more attention from the investor basis, which is really good for a lot of our clients. But if you take a look at the classical loan product, it is for the first point, it's a lot of work to do, and our clients do not see the advantage, because in the end, liquidity, the market is in Europe is very, there's a lot of liquidity. In the end, money is very cheap to get. And if you talk about the use of proceeds, you, as a client, you first of all want to be flexible, and you do not want to report on the money that you have just borrowed. And this is an aspect that makes some of our clients very much reluctant, even in the classical German Mittelstand, which means that is small and medium-sized companies.
Mm-hmm. Thank you. A comment on this, maybe from you, Joachim, or Stephen? From your perspective, maybe?
If I may, yes, certainly to say that broadening the base of investors is what what is behind a lot of this policy. And I would add to that what we saw in the first presentation of structuring investments to bring in both the public and the private sector. And of course, the sensitivities around disclosure will always be there. And in that sense, that is something that is a balance that the regulator will need to strike in each case.
Okay. Julia, is there any question from the audience? Maybe
Yes,
to this?
We've received a question that maybe fits quite well to this. It's a twofold question, but I think the second one now is the second part is a good point now. It's Katarin, again to you about HSBC's approaches and to what extent they align with those used by other banks.
So in the end, I think it's so we are much in line with other banks. So we are not the best. We are not we are not very much behind. So we would like to be a leader, of course, in regard of sustainable finance, but we are very much in the beginning, to be honest. In regard of disclosure, the decision that we did to disclose on TCFD in the end gave us some more advantage because we needed to set up a new strategy and a kind of change management process. So in the end, our processes need to be aligned with climate and in the end transition risk, which was very, very good because in the end we do have a sustainability department for years now, but this has always been very much probably far away from the rest of the core bank. So in the end, it was all about social and environmental activities, which we did for free and because we thought it's our responsibility to do so. So now the regulator came up, which on the other hand might be some sad because it might have been easier to do something voluntarily and to kind of have a more intrinsic motivation to do a sustainable or to set up a sustainable business in the end. But what I guess is that some of the French banks might be some more advanced than we are. In the end, what I know from the discussions that I have with other sustainability managers in Germany or in Europe or globally, it's everywhere the same case, to be honest. Yeah.
And maybe about the second part of the question, you spoke also before about shifting financial flows so that they're consistent with the Paris Agreement. And the question is now whether or where HSBC is actually reporting its green and brown investments to support the evaluation of this shift.
We do report about our investments within our strategy report. That is part of our annual report. And besides, we do have an ESG report that comes out twice a year. And this gives us this gives you more insights on the TCFD approach and our kind of TCFD journey, which is a broad term for our TCFD disclosure so far. And this is in line with the Paris Agreement, and we do consider SDGs for our strategy. And what we know is that, of course, not only the regulators want to see a strategy behind transition risk, but also our investors and our clients at the end. So it's always an approach in regard of all the three, so regulators, governments, and clients or investors.
Okay. Julia, maybe one more question. We are already a little bit behind the time, but maybe we can address one more question and then probably we have to come to an end for today.
Sure. We have one more question from Andrea, who's asking how banks are looking forward to a new market mechanism under the Paris Agreement. Would it be an investment opportunity and a new way to mobilize funds? CDM, despite the many criticisms, was very efficient in boosting private capital, yet banks move in too late.
Can I give an answer to that one as well?
So who would like to take it? Shall I take it? Or do you want to start and I will give some?
Only one remark. When we were developing this type of programs, and in all, this is one of three. We are developing another program that deals with energy efficient cooling and also using natural refrigerants for ACs, also in the Southern African region. And then another one that deals with the deployment of green hydrogen in the transport sector. I can tell you, when it comes to the introduction of such a new technology, that you always need to have a bank on board. There's no way out of that. And it's not only a development bank, it's also private banks that need to get involved in that one. And they are aware of the opportunities on one side. On the other side, they are very much afraid of the risks, because it's unknown to them. A lot of new technologies, not really proven in the countries, high perceived risks. So, and it's all about, as Stephen has said before, how to lower the interest rate to create a business case for the private sector, because at the end of the day, you need to crowd in investments from the private sector to reach the targets under the Paris Agreement. There's no way to do that only based on public climate finance or by using carbon finance mechanisms. So, and there the banks are really reluctant in the first place to go for something like that unless you really clearly can define the business case. And then you might have a chance to get them on board. But it's a real long procedure. I can tell you from our own experience that when we did the development of the TD losses program, the most complicated issue was the discussion that we had with the financing partners. It took us about, I would say, 2 years to really come to financial closure to this for this program. And this is really something where I would like to see that banks are really willing to take a little bit more risk and also become more responsible for the implementation of such activities in their countries. It's a real challenge, I can tell you.
Thank you, Katarin.
Yeah, so in the end, I totally agree, and I have nothing to add, to be honest. So it's all about the learning curve. So if you decided to take up the steps and to try to set up a green loan, a green bond, etc., you finally see that it's much more easier than you thought in the beginning. But you do need to, in the end, you need to be willing to do it. And we don't have the one and only answer to these questions. In the end, we are trying, and we are having a lot of dialogues with our clients. Due to COVID, of course, the market has extremely changed, and hopefully climate change is still an aspect that governments and the society will still cover. Sustainable finance is an opportunity to set up a sustainable development. And in the end, if banks do consider climate risks and risks that come from high risk sectors such as steel and cement, and do try to set up thresholds, for example, within the loan assessment, this is a very good starting point to do so. Yeah, and I don't think that I have much more to add. Yeah.
Thank you very much. Yeah, again, thank you very much to all of you. Thank you very much for the presentations, for the discussion, and also thanks to the audience for raising some questions. Unfortunately, we need to come to an end. We're already 15 minutes behind, so we will close the session for today. But I want to mention that questions that maybe were still in the Q&A box that we haven't addressed during this webinar, we certainly will follow up on those afterwards. And yeah, I think we learned a lot today. We learned that we definitely need to incorporate technology standards into our corporations, maybe or potentially under the UNFCCC. So again, thank you very much. I would like to maybe go on the last slide for today, just to make you aware of our next sessions that are coming up. As I mentioned in the beginning, we have this webinar series consists of 4 sessions. Today we close the 2nd session, and in the next session next week, Wednesday again at the same time at 3 p.m., we will look into the implementation of technology corporations with a case study from Africa. We will have in the panel a CTCN, the Africa Business Network, German Energy Solutions, and the Africa Green Tech. And then the week after, we're going to look into the upscaling of technology corporation, and we look into the example of e-mobility with CTCN and PEM Motion. So again, thank you very much for participating. If you want to sign up for the next sessions, you can do so on our website, nde-germany.de. Thanks again to all of you, and thanks for listening, and have a good day, everyone, and see you hopefully next week. Bye.
Bye.
Bye. Thank you.